welcome to the presentation of Group 6. Today we will be presenting Topic 5 on mergers, demergers, and acquisitions. My name is Dreyaska Naidu, and presenting with me today are my colleagues, Devashlin Pillai, Salik Ali, Ricardo Pariachi, Lindakush Lelushaba, and Keegan Naidu. We will start by defining a merger. A merger occurs when two or more independent companies agree to combine and establish a new firm. This has many advantages, a few of which include the decrease of costs, decrease of risks, increase in market share, or even increase in profits. There are three different types of mergers. A horizontal merger, where companies from the same industry decide to form a merger, and an example would be Coca-Cola and Pepsi, both being from the beverage industry. And a second type of merger is the vertical merger. This is where companies from similar industries but at different points of the supply chain of the production of similar goods decide to form one company. An example would be a leather manufacturer and a handbag manufacturer. So the leather would form an input into handbags, and they are able to reduce costs if they bring those activities into one company. The last type of merger is a conglomerate merger, where companies from completely different industries decide to form a new company, and this could be beneficial as they're able to reduce their risks at different parts of the business cycle. We will now move on to acquisitions. An acquisition occurs when one company tries to gain control of another company's assets and management. There are two parties involved. The acquiring company, that usually is a little bit more financially wealthier, and the target firm. This is the firm that's trying to be acquired. In order for the acquiring firm to achieve gaining control, they are required to own at least 51% of the target firm's shares. In contrast to a merger, the acquisition doesn't require both parties to consent to the acquisition. In the case where the target firm is opposing this acquisition, it turns into what we call a hostile takeover. In this case, all that the acquiring company is required to do is convince the shareholders of the target firm to sell their shares to them, and so they gain control in that way. Finally, a demerger. A demerger occurs when a large organization separates into a smaller organization. This involves the dissolution of an earlier formed merger as well. In the case of ownership, it remains consistent throughout this process, as existing shareholders will receive shares in the smaller organization in proportion to their ownership in the larger organization. There are 5 different types of demergers that include spin-offs, split-ups, split-offs, equity carve-outs, and finally, divestitures. We will now look at the difference between demergers, mergers, and acquisitions.
Hey everyone. It is my duty to take you through the similarities, differences, and motivation for a merger, acquisition, and demerger, respectively. The main thread that runs between a merger, acquisition, and demerger is its underlying motivation. This can be seen through expanding your market share, entering new markets, reducing operational costs due to increased efficiency, increasing your revenues, thereby widening your profit margins. The differences between a merger, acquisition, and demerger can be broken down into 5 categories. The first being style. With regards to a merger, it's when two firms combine into one firm. An acquisition is whereby one firm takes over another, and with regards to a demerger is when one firm breaks up into 2 or more independent firms. With regards to decision, a merger and a demerger is mutual, and an acquisition, due to its nature, is a hostile takeover. With regards to firm size, the merger is when firms are similarly sized, and acquisition is whereby the takeover firm is much larger, and with regards to a demerger is when one large firm breaks up into 2 or more smaller firms. The fourth category is dilution. With regards to a merger, semi-dilution occurs. In an acquisition, full dilution is seen, and with regards to a demerger, no dilution occurs. The last category is shares. In a merger, new shares are issued. In an acquisition, no new shares are issued, and finally, in a demerger, shares specific to each independent firm are transferred to them. The motivation for a merger and acquisition can be combined. The first is revenue enhancement. This can be seen through a horizontal merger or acquisition due to decreased competition, as well as a vertical merger or acquisition due to increased efficiency. Cost reduction is also seen due to increased efficiency. Lower taxes, this is quite prominent when one of the firms has a large loss. Reduced capital requirements due to the sharing nature of the business, as well as diversification, which is quite prominent, especially in a vertical combination. The motivation for a demerger is as follows. The first being divestiture gains. This can be broken down into the two types of demergers, being either a spin-off is when a separate legal entity is made, or a carve-out is when you're selling out a portion of a business unit. The second is to streamline your corporate structure, as underperforming business units can be given the more attention that they need. And finally, improved profitability can be seen through increased efficiency.
Before measuring, tracking, and communicating value creation, it is important to understand value creation and enable a value-creating business model. This can be achieved through a management process of defining, creating, delivering, and sustaining value. Value is ultimately defined by customers, investors, and other stakeholders, created through the firm's purpose, strategy, and business model, delivered to various stakeholders through appropriate pricing of products and services, sustained by retaining and protecting value internally and appropriately reinvesting. Firms exist to try and create shareholder value, and to achieve this objective, they try different business strategies and innovations. Mergers, acquisitions, and demergers are some of the strategies firms can use to try and create value. The success or failure of mergers and acquisitions has huge effects on the firm and its stakeholders. Mergers and acquisitions are regarded as good long-term investments, as investors expect that the combined firm will be more efficient due to the combined management teams, but this is not always the case. In 2020, IRASA stated that economies of scale and changes in market share prices influence shareholder value, and that any increase in any of these two factors, amongst others, gives the firm a competitive advantage over price and its revenue grows. According to Sudha Sanam, the wealth gains of mergers and acquisitions are measured by abnormal returns. Kumar and Suhas found two distinct approaches to evaluate merger-related gains from academic literature. The first approach compares the performance of the firms based on accounting data before and after a merger to determine whether consolidation results in gains. The second approach examines the stock price performance of the bidder and the target firm around the announcement of the merger. Horizontal mergers are found to create shareholder value because they lead to geographical expansion and give access to specialized resources. Similarly, DeLong conducted a study based on 54 bank mergers announced between 1991 and 1995 and found that upon announcement, the market rewarded mergers that focused on their geography, activities, and earnings stream. However, Fan and Goyal claimed that vertical mergers are considerably better at creating shareholder value, but this was opposed by Shin, Xu, and Zhou, as they found that profits decrease after a vertical merger. On average, target firm shareholders enjoy positive returns in almost all cases, whereas evidence on buyer firms is less conclusive. Several researchers have reported that value creation is lowered for listed target companies than for private target companies. However, Bayazitova stated that regardless of a negative announcement return for acquisition of public companies, they typically do not destroy value. However, only about 1% of mega mergers actually destroy value for the acquirer. Opposing this view, Sudasanam stated that shareholders of the acquirer firm experience wealth losses, whereas shareholders of the target company experience abnormal returns ranging from 20 to 43%. Later on, Edmonds, Fan, and Huang stated that mergers and acquisitions create value in the short run, but this is at the expense of long-run value. This view is backed by the hubris theory, which states that managers may overestimate the value created by the merger initially in order to maximize value, but that this value will return to its normal or true value in the long run. Demergers are often viewed suspiciously by investors as they assume that they hint at failure of the merged cooperation, but contrary to popular belief, they are actually a good way of focusing your resources and energy on a single business. In a study on the impact of demerger announcement, Kirchmeier found that the announcement transaction had positive abnormal returns on shareholder wealth. This was supported by Padmana Baham in a study made on 63 companies over 11 years, where he found similar results. Khurana and Gupta established that in the long and short run, significant increases in the market capitalization of demerger firms in India is seen due to increased focus. In another study, it was found that for parent companies, the announcement news does not affect shareholder wealth in the long run. These findings are supported by Mehta et al., who found that this is due to investors adding company fundamentals to their investing decisions. Using financial efficiency ratios, Singhal found that approximately 55% of his sample company's wealth decreased after a demerger and the rest increased. From the above literature, it can be concluded that mergers, acquisitions, and demergers frequently create value in the short run due to the market's perception of a positive return. While many target firms benefit, literature is inconclusive on the effects on parent companies. Majority of literature indicates that in the long run, the firm value will return to its true value.
Case study 1 begins with the merger of Barclays Bank and ABSA, which took place in May of 2005. This is an example of a horizontal merger. A horizontal merger is a merger when two firms from the same industry or similar industry join their operations. The advantages of this are bigger economies of scale or increased revenue. The success of the merger can be measured in 4 different ways. The first is earnings per share. The earnings per share for ABSA has more than doubled since the merger, which indicates that ABSA has been able to add more value for its shareholders. Second is the return on assets. The return on assets for ABSA since the merger has seen reasonable growth, which indicates that the ABSA management team has gotten more effective at using the company's assets to earn profits. Thirdly is the return on equity. The return on equity has grown by almost 5% since the merger, meaning that the merger has helped ABSA give a better return to its equity shareholders. Lastly is the debt-to-equity ratio. The debt-to-equity ratio has decreased significantly since the merger, meaning that ABSA has gotten better at paying off its debts and is now more attractive to investors. Since the merger, ABSA has created more value for its shareholders, the management team has gotten more effective, and the company has decreased its risk. Therefore, we can say that the merger between Barclays Bank and ABSA was successful.
The case study for an acquisition was a deal between Renault SA and Imperial Car Imports. The acquirer is Imperial Car Imports, which is a subsidiary of Associated Motor Holdings, which is owned by JSE-listed Imperial Holdings Limited. The motivation was to accelerate Renault's growth in the South African automotive industry by facilitating a change in management base from French to South African. The economic school analyzes the wealth created for shareholders by evaluating the return on equity, return on assets, and the earnings per share before and 2 years after the acquisition. As a result of the acquisition, Renault SA generated excess returns for shareholders while utilizing assets more efficiently, as all 3 of these ratios improved. Strategic Management School considers the similarities of the core operations between the two companies, as the high similarity allows efficiency synergies to emerge by decreasing costs and improving the overall performance of the company. As Renault SA and Imperial Car Imports have highly similar and complementary operations, this increases the probability of a successful acquisition. Organizational behavior school considers the cultural fit between the acquiring company and the target company. Merger and acquisition success increases with the cultural fit and the integration of companies. Since the new managers of North SA will be South African managing French employees, this might be a problem. However, there is not enough evidence to investigate this effect. The process school considers the speed of integration between the acquiring company and the target company, as this influences the speed at which returns to synergies can be realized. However, this can also not be evaluated in this acquisition between Imperial Car Imports and Renault SA. Due to the successes highlighted in the financial economic school and the highly similar and complementary resources between the two companies, the acquisition may be considered as a success.
The third case study is on BHP Bulletin and is an example of a demerger. This case study follows the creation of the spin-off company South32, formed in late May of 2015 with near unanimous shareholder approval. One of the top prospects for BHP to demerge was portfolio simplification, allowing for greater asset efficiency. The prospects for South32 were good balance sheets with 40% dividend payout biannually to shareholders and a diversified portfolio. To evaluate whether the demerger was a success, we look at 4 categories set out by Kirschmeyer in 2003 and financial indicators to determine the value difference. The first category is the dismantling of conglomerates. We consider this a success when demerged costs are less than joint costs. A failure is an opposite effect, which is the case for the following categories as well. BHP had estimated an increased per annum costs. The demerger has failed in this regard. However, in terms of capital market, organizational and corporate governance improvements, the demerger is a success. Core asset efficiency has improved and new investment opportunities arise due to the separation of South32's assets. This is a success in capital market improvements. BHP's portfolio is simplified as a result. This lowers functional costs and allows for more concentrated portfolios. The prospects of South32 mentioned earlier are favorable as well, and therefore organizational improvements are a success. There is a reduction in information loss due to the hierarchy in a conglomerate as well. Fourth category is corporate governance improvements, relating to effective recruitment of new management for both firms and established head offices. Returns and balance sheet discipline were realized because of the well-established head offices. This signifies corporate governance improvements as a success. The financials improved as well. EBITDA increased by 26%. EPS went up by 7.6 US cents from 2014 to 2015. And the return on invested capital increased by 2.2%. More money is good, and so this is a success for demerging. The success and value creation in the respective criteria outweigh the cost of the demerger. This results in a net positive for the value of the demerger and therefore an overall success for the demerger.
And that brings us to the end of our presentation on mergers, acquisitions, and demergers. We do hope that we were able to supplement your knowledge on this important concept in finance, and please do feel free to ask us questions at the end of the presentation. Thank you.